Welcome back to the deep dive. We're just swimming in market news these days. Headlines yelling, numbers flying everywhere. It's tough to really know what's going on under the hood. So today, that's our mission. We're cutting through that noise. We want to give you a really unique, data-driven look at global markets, help you make sense of it all.
And we're doing that by digging into the work of Michael Oliver, a real veteran market technician. We're talking nearly 5 decades of experience. He founded Momentum Structural Analysis, and he's one of those rare guys who actually called the '87 crash beforehand, saw it coming. What makes him stand out, really, is this knack for spotting huge market shifts, the big ones, before everyone else catches on.
Exactly. Think of this as your shortcut. You get to be really well-informed, fast. We're promising some surprising facts, a fresh perspective on, well, everything. Equities, bonds, commodities, gold, even crypto. So let's peel back those layers, see things differently. Okay, let's kick things off with Oliver's most heretical view, as he puts it. He believes our monetary system is basically heading for an implosion. That's a heavy word, implosion. What's he really mean? Is it like total collapse or something else? How does he see this happening?
Yeah, it's a big claim, and it's totally central to how he sees the world. His argument boils down to this. Ever since governments ditched gold-backed money and central banks just kept printing more and more money, look at the USM2 supply doubling every decade, faster recently, we've ended up with what he calls a distorted yardstick.
A distorted yardstick.
Think about it like this. Your granddad buys a house for, say, $4,000. Today, the median house is, what, $445,000? Or bread for 20 cents versus today. It's not just inflation. It's like the money itself isn't worth what it was. It's lost its real buying power. And that fundamental distortion, he argues, creates instability right at the core.
Okay, so if that's the messed up foundation, how does Oliver use his unique approach to look at the markets now? Especially the U.S. stock market, which looks unstoppable to most people. And maybe explain this momentum idea for listeners.
Yeah.
How is it different from, the usual indicators like RSI, those wet noodles?
Right, good question. So think of price charts like seeing a car's location on a map. It tells you where it is. But Oliver's momentum analysis, that's about the car's force, its direction, even before it makes the turn. It's the underlying push. Those standard tools, RSI, MED, he calls them wet noodles because they often lag. They react after the price already moved.
Yeah.
His method, oscillating price against its own moving averages, creates this unique wave pattern. It can flag shifts months, sometimes years, before the price chart shows anything. It reveals the hidden structure, trend lines, floors, ceilings that price alone just hides. Let me give you a concrete example.
Yeah.
Back in early 2012, momentum showed gold breaking a multi-year uptrend. You couldn't see that on the price chart at all.
Really?
Yeah. And the price, it didn't crash until a year and a half later, or flip it around. February 2016. Momentum signaled gold was entering a bull market even though the price had barely moved off its low. So this method, it gives you a real edge. You can spot these aha moments much faster, gain that knowledge without drowning in data because you see the shifts early.
Got it. So Oliver's saying the price we see is often just noise, or maybe the result of deeper forces. His method helps you see the market's true architecture, its potential weak spots, way before they crack. That makes sense. Okay, let's pivot to the U.S. stock market now. Looks strong on the surface, right? But Oliver calls it the biggest bubble. How does he square that with, say, strong earnings or the AI hype that many analysts point to?
Well, he looks at this bull market running since '09 and says it's just unprecedented. The NASDAQ 100 gained 19 times its value. That's 15 years long, way longer, like 3 times longer than most bull runs.
15 years, wow.
He sees this as the biggest bubble because it's built on compounded errors, a decade and a half of that monetary distortion, basically free money inflating assets, not real economic growth.
And he mentions this specific pattern, the Edwards and Magee broadening top. What does that look like, and what's it telling us?
Right, the broadening top. Imagine prices swinging wider and wider, up and down, making a kind of megaphone shape on the chart. Historically, that's a really bearish sign. It signals like extreme volatility, a loss of control. And Oliver sees the technical action right now as highly similar to 2000 and 2007, just before those big drops.
Okay.
We saw highs, then that sharp drop, and now this recent new high that he says has put everybody to sleep. Remember 2000 to 2002, S&P down over 50%, NASDAQ 100 crashed 82%. Took 16 years just to get back to the same nominal price level.
Ouch.
So he's seeing the same warning signs now. It's like a dangerous deja vu. He calls the current rally a fake out, maybe partly due to orchestration from above, positive talk about tariffs, while ignoring the 15 years of underlying problems. And look at the narrow leadership. Only 3 of the big Magnificent 7 stocks actually made new highs recently.
Really?
Lately.
3?
Yeah, most S&P 500 stocks aren't at their old highs. It suggests the market's being propped up by just a few names, masking weakness underneath. And here's the immediate warning. There's a specific signal number, he tracks it weekly, that's just a couple % below where we're trading right now. If the market breaks below that number, that's the sign the fake-out rally is over.
Okay, so not necessarily an instant crash, but a serious downside move.
Exactly. Maybe not 87 style, but significant. And the real-world ramifications for you listening? Well, if retirement funds drop 20–30%, that hits jobs, people's sense of stability. It triggers a lot of emotion.
And it's not just stocks, right? You mentioned the U.S. government debt market. That's another key pressure point for Oliver.
Oh, absolutely. Government bonds, they've been stuck at these high-choking yield levels for 3 years now. He says this isn't like the 07–09 mortgage mess that could be sort of washed away. This has deeper roots. These high yields are squeezing corporations, especially in commercial real estate with big debts coming due. And it hits regular families, too. Higher mortgage rates, credit card debt.
Yeah, you feel that.
So this forces central banks, the Fed here, even the Bank of Japan with their JGBs. Oliver notes Japan kind of earned it by inventing QE. They have to step in as the chief fighter to prop up government debt, which means more money printing, more monetary excess. And that, he says, just fuel injects the gold uptrend.
So the Fed's really boxed in. Let yields rise and risk a crisis, or print more money and make the distortion worse. It's fascinating how precarious that sounds, despite, Chairman Powell sounding reassuring in public. What does Oliver think the Fed has to do?
Right. And if you look closely at the official job numbers, they don't look good. A lot of the growth is just government hiring. Oliver thinks Powell will be forced to cut rates, probably sooner than people think. Plus, there's this risk of a mini panic in the bond market. If the TLT, that long-term bond ETF, if it drops several points below $83, that could trigger a really sharp, rapid decline. And that would force the government into almost military-type steps, really dramatic central bank action. He even brought up a Boston Fed official saying they had miscellaneous tools ready beyond just rates and QE.
Miscellaneous tools. Sounds ominous.
It implies they might do things we haven't seen before. And the bigger picture here, the Fed itself, this institution we see as permanent, could suddenly look non-functional, maybe even be gone in a couple years, he speculates, because it just hasn't managed these boom-bust cycles well.
Wow, okay. Let's shift gears to commodities. They had that big recovery starting late 2020. What's Oliver's take there, especially considering things like the Ukraine war?
Yeah, the Bloomberg Commodity Index, it doubled from under 60 to 140 by early 2022. But even at 140, he points out, it was still dirt cheap compared to history, like the 2008 peak near 237. And here's a key point. Commodities actually peaked just weeks after the Ukraine war started. They were already rising before the invasion.
Ah, so the war wasn't the primary cause.
Exactly. It counters that common story that the war caused high oil prices. He sees the rise as driven by market momentum building up well before that.
Okay, so if commodities are reasserting themselves based on these deeper momentum shifts,
Yeah.
what does that mean for you and me? Are there specific levels we should watch that signal this new wave he talks about?
Yes, definitely. Keep an eye on the Bloomberg Commodity Index closing a month above a 106.50. And for crude oil, watch for WTI closing a month out at $70. These are what he calls momentum structural breakouts.
Yeah.
They're not obvious on a price chart necessarily, but they signal a major new upward wave is underway. And if that happens, if gas prices and other commodities really start moving up again, that's a psychological ambush for consumers.
Yeah, definitely feel that at the pump.
It creates this sense of uncertainty, stirs up emotion, and could really shake confidence, maybe even in political parties promising low prices.
All right, let's talk gold. It's been kind of flat for a few months, moving sideways. Some might think it's losing steam, maybe topping out. But Oliver calls this period a launch pad, not a top. Why? What's the momentum telling him?
He makes a great point. Gold never made a major low or a major high going to sleep. Sideways action isn't weakness for gold. The long-term momentum shows no point of vulnerability at all. Any pullback now is just in trend, a pause within the bigger uptrend. And what's really telling, he says, is that while gold consolidated, gold miners and silver have shot up sharply.
Ah, so the miners and silver leading the way.
Exactly. And silver, historically, it's gotten incredibly cheap relative to gold, down to like 900 tenths of 1% of gold's price at one point. That's one of the lower levels it's been in history. And that sets up what he calls a slingshot situation. In fact, he mentioned his personal portfolio is like 80% in silver miners right now.
80%.
Yeah, he expects silver to outperform gold dramatically, talking easily $60–70 silver in just a few months, blowing past those old $50 highs.
And that ties into his bigger picture view for gold potentially hitting, what, $8,000, $9,000. That sounds astronomical. Is that a target or more of a reflection of past moves?
It's more based on history. He notes prior bull markets saw gold make roughly 8x moves from the absolute lows, like leading up to the 1980 and 2011 peaks. So applying that kind of multiple isn't a specific prediction, but shows the potential scale if history rhymes. And long term, he doesn't see gold and silver crashing when this bull market ends. He thinks they'll plateau.
Yeah.
Why? Because he believes governments will eventually have to return to some form of gold-backed currency because of the current system's failures.
A return to gold. Interesting.
He even points to China's Shanghai Gold Exchange letting foreigners trade gold for yuan. Maybe a stealth start to a global repricing, shifting eastwards. Bottom line for now, if gold closes over $3,400 again, that blows out the range. Expect acceleration in silver and miners then.
Okay, last stop. Crypto. Bitcoin hit all-time highs. Lots of excitement there. But Oliver's warning about weakening momentum, structural risks. That seems counterintuitive. Let's unpack that.
Yeah, his view on Bitcoin is pretty stark right now. He says it's on the edge of not only calling it a major bear, but a potential crash.
Crash.
He draws a direct parallel to the S&P before the '87 crash. There was a key moment. The price chart looks like an upward staircase, sure, but the quarterly momentum chart that suggests a break below a critical level could lead to a sudden jolt, not a slow decline. He also points out the brother and sister relationship, how Bitcoin futures often track the Nasdaq Q100 if both slip back under their prior highs. That's a big red flag for him. And the implications now are bigger than before. Bitcoin is deeply attached to financial institutions.
Right, the ETFs and all that.
Exactly. So if Bitcoin drops hard, it creates real financial repercussions outside of just crypto holders. Think about MicroStrategy holding massive amounts of Bitcoin or the already stressed commercial real estate market. Risk is interconnected now.
What about Ethereum? Some see it as maybe catching up or a bit different.
He sees Ethereum as much weaker, calls its performance anemic, points to a negative long-term momentum trend. It never made a new high alongside Bitcoin this last run. For him, Bitcoin is the real ambush risk because its momentum structure is clearer, and crucially, because of those deep institutional links now. He basically concludes that Bitcoin, whatever its original promise as, unprintable money, it's become just another speculative bubble behaving like the Nasdaq Q, not like an alternative currency like gold.
Well, this has been quite a deep dive. Some really powerful insights here about looking beyond the surface price, understanding that underlying momentum, those monetary distortions. It really changes how you see the financial world.
Yeah, and Michael Oliver's final thought really sums it up. He expects market dynamics to get very volatile and move quickly between now and the end of the year. It could lead to a very sudden realization for many people about what's actually been going on beneath the surface.
So here's something to leave you with. In a world where the financial foundations seem increasingly shaky, where that yardstick of money itself is changing fast, how will you choose to position yourself for whatever comes next? What does stability even mean? And what aspects of it will you prioritize?